All right, welcome everybody. My name is Bethany Dennis. I'm with the Rutgers, New Jersey, New York Center for Employee Ownership. Thank you for joining us this afternoon. I'm going to be your host and moderator. So this is Employee Ownership Trusts. Many of you might already be familiar with employee stock ownership plans as a form of employee ownership. However, selling to an employee ownership trust or an EOT can be a strong alternative to an ESOP, where the cost of an ESOP is a major consideration, as well as where the sustainability of the employee ownership structure is a major goal. So today we're going to learn why and when an EOT might be the right option for business succession. So this webinar is scheduled for about 45 minutes and with 15 minutes allotted for Q&A at the end. Participants, please stay muted. You can keep your cameras on if you like, and submit any questions you have in the Zoom chat, and then Chris will answer them at the end. So now I'm going to turn things over to Jim Terez. He is the Associate Director of the New Jersey, New York Center for Employee Ownership, and he's going to speak briefly about some of the center's major accomplishments from this past year, as well as introduce our new employee ownership online education program, which is launching February 1st. All right, Jim, over to you.
Thanks very much, Bethany. Welcome, everyone. Thank you for joining us, and thank you to Chris and Bill for joining us today. I'm really excited to hear what you have to say about Employee Ownership Trust today. I'm Jim Terez. I'm the Associate Director of the Center for Employee Ownership, and I just wanted to mention a couple of projects that we've been working on and that you can check out both today and in the near-term future. The first project is a report that the center did based on prudential sponsorship. It's studying opportunities for employee ownership among minority veteran-owned businesses, and the report that was generated from our research is available on our website. So you can go to our website and find it there. And then I also wanted to mention that we had a conference in November. I think that we had a really great set of sessions, et cetera. It's archived on our website as well. And so you can go there and check out any of those particular sessions. I was thinking that some of the session in particular provided an incredible foundational sense of some of the features and requirements for employee ownership. And then the other project, which is upcoming, that I wanted to mention is thanks to some great sponsorship from the Kellogg Foundation, we have put together, people in our center have put together a new online educational program to provide information, in particular to minority and female business owners, about employee ownership strategies. And it's going to be free. It's not available yet, but it will be available in the next maybe 2 to 3 weeks on our site. And so you'll hear more about that. We're really looking forward to being able to spread the word a little bit about employee ownership. So stay tuned, basically. We're excited about all these developments. Anyway, I want to introduce our two speakers for today. I'm so glad that they were able to join us. Chris Michael is the founder and managing director of EOT Advisors. He himself is basically responsible for developing the Employee Ownership Trust as a financial and legal mechanism in the United States for employee ownership. And he has published a lot of articles introducing the concept into leading peer-reviewed journals, including journals like Tax Notes and Probate and Property. Chris also teaches at Rutgers. He's a professor at Rutgers in the School of Management and Labor Relations, and he was recently named as managing director for the Institute of the Study of Employee Ownership and Profit Sharing at Rutgers, of which the center is a part. Chris is joined today by Bill Foster. Bill's Chief Executive Officer of BioWorks, located in Rochester, New York. For over 25 years, BioWorks has been helping growers in the horticulture and specialty agriculture markets to successfully deliver crops to market with biologically based solutions and support. Bill and Chris are going to discuss the sale of Bill's company to an employee ownership trust. Bill and Chris, thank you so much for joining us. We really appreciate it. Thank you.
Thanks so much to Jim and Bethany, and to the New Jersey, New York Center for Employee Ownership, and to Rutgers as well. I can't wait to have an interview with Bill, and we're going to talk about his sale and transition to an employee ownership trust. I thought it might help, though, initially to do a run through in about 10 or 15 minutes what an employee ownership trust is, because it's still a new concept here in the United States. So it's hard to even begin to talk about employee ownership trusts before first speaking about John Lewis Partnership. It's kind of the North Star for employee ownership trust the world over. It's basically like a Macy's in the UK. They also have a large supermarket chain attached at the hip, and all of it is an employee ownership trust. It has about 90,000 employees. They did 14 billion in revenue in 2020. They've been around under employee ownership for almost 100 years using the EOT model. And in the UK, where EOTs are the mainstream form of employee ownership, ESOPs aren't the thing in the UK. People refer to this model as the EOT model or the John Lewis model. And politicians on both sides of the aisle in the UK speak about possibilities for a John Lewis economy. So what is an employee ownership trust? An EOT is a trust that holds some or all of the shares of a company on behalf of most or all of the employees of the company. Just like an employee stock ownership plan, it offers employee ownership, which is to say that it provides that the profits and gains of the company are shared by the whole team in an equitable manner. Also, that the corporate governance is directed towards the best interests of the whole team of the employee owners. And also it provides an opportunity to develop an ownership culture at the company that enhances and improves the quality of work life. Now I can't help also but define here in the United States, but to discuss how an EOT is different from an ESOP. Because ESOPs here in the US are the norm for employee ownership, right? There have been tens of thousands of ESOP businesses over the last half century. An EOT is different from an ESOP for a few reasons. One is an EOT is not a retirement plan. It's not a way of deferring payment of tax. It doesn't offer a way of deferring payment of taxes like an ESOP does. It's also not regulated by ERISA or under ERISA. For those same reasons, because it's not a retirement plan, because it's not regulated under ERISA, there's no need for annual valuations. There are no repurchase obligations. There's no third-party ERISA administrator required to keep track of employee share accounts, right? So that substantially reduces the complexity. These features substantially reduce the complexity and burden of operating an EOT company. One way to think about EOTs might be that EOTs are employee ownership just without the ESOP piece. Another way to think about EOTs, and I'll return to this concept later on in the presentation, is that EOTs are a private, flexible, low cost, easy to understand, and I might add sustainable alternative to the ESOP. So if you remember nothing else from today, I mean, two key points. If you want to kind of start from square one and kind of you can almost figure it out for yourself what the differences are. If you just go back to square one and say EOTs are different because once the shares go into the trust, they stay in the trust, generally speaking, and the employees, as they say in the UK, are naked in, naked out. The employees aren't buying shares, and when they leave the company, they're not being bought out of any shares. The benefits, the financial rewards to the employees come while they're working at the company, typically in the form of profit sharing. That, again, I have to say, is speaking in general terms, using a kind of a default approach to structuring an EOT, as actually you'll hear later today with Bill. There are other approaches that you could use. So this is at this point in my sort of typical presentation, I like to stop, pause, and say, well, if EOTs, Chris, if EOTs are kind of neat, different, cool, offer these benefits and advantages, how come we haven't heard of it before? EOT, it looks like some kind of strange new frat that I haven't heard of, right? So here's my quick 1, 2, 3 answer to the question of why we haven't heard about EOTs much in the US before. And I think the answer really boils down to that guy in the black and white photo with the bow tie at the bottom of the page. Lou Kelso in the 50s leveraged tax code that was put on the books back in like the 20s and created something called what he called the Kelso plan. It's what we now know as the ESOP. It was called it was called the Kelso plan at that time. And him and his wife Patricia Heder marketed the Kelso plan. They went all over the country, wrote big books, went on TV, flew all over the country, and pushed the concept for decades before it ultimately landed in federal law when ERISA was legislated. And if you go further back in US history, it turns out that we had EOTs in the past in the US. In fact, it's quite possible that John Lewis got the idea for an EOT from a US company called Columbia Concert Company. The structuring for that deal was actually done by a Chicago economics professor who later became the US Senator from Illinois. A few years later, after that company was formed, is when John Lewis did his EOT. I can't establish the connection firmly, but the dates make it seem like there really might be something there. So, you could imagine an alternative history where the US follows the trajectory that the UK followed, which is that EOT becomes the mainstream form of employee ownership. But some people have an outsized impact on history, and I think Lou Kelso, at least in the employee ownership sphere, is certainly that person for us in the US. And after the ESOP was legislated under ERISA and additional tax benefits were conferred on the ESOP in 1984. Well, kind of the rest was history. John Menke, who was a senior tax associate with Lou Kelso, set up the first ESOP shop, has done thousands of ESOP companies. Corey Rosen founded the NCEO in 1978, has helped also facilitate thousands of ESOP companies. And again, the rest was history. So things have only changed in the last few years. As Jim mentioned earlier, I published a few articles explaining how the employee ownership trust is an alternative structure for employee ownership, alternative to the ESOP that we can do today, that we don't need any new law for, published in Tax Notes and Probate and Property back in 2015 and early 2017. And I started doing the first EOT transitions back at that time as well. Launched EOT Advisors in 2017 properly. And in this published research, I show that the traditional EOT, same way it's kind of always been done, is not subject to ERISA, that existing US trust law works. You can do this in any state if need be using another state's trust law, which is totally common when it comes to trust law, picking a jurisdiction that is best for your purposes. And I also, if I have any kind of minor contribution here, it's showing that you can use something called a non-charitable purpose trust, which is a new development specific to US trust law, is a very handy tool when you're structuring employee ownership trust. And there are some of the advantages are listed there. So EOT Advisors then is the first investment banking advisory services firm in the country dedicated to assisting business owners sell to an EOT. We work all around the country. We've been involved in about 15 closed US EOT transactions. That's about all of the US EOTs to date. And we're on track to double that number by the end of the year. Here are some sample clients. Actually got to get BioWorks up there onto the slide. I haven't refreshed this since the beginning, since earlier in the year, last year. So folks want to know, now you can use an EOT with really any company that is a sustainable, viable business with a leadership team in place. Nevertheless, so you could go down to 10 employees with million or two in revenue. That can work. You could do this with a billion-dollar company, and anywhere in between. That being said, people often want to know what the kind of typical company looks like for an EOT transition. And at the moment, typical client size enterprise value is about $10 to $20 million range. Now, it certainly can go again below that, so down into the couple million, single-digit millions enterprise value, but it can also go significantly above that. So I'm working with a client right now that's probably about $500 million enterprise value. Typical workforce size, again, it can be lower than this. It can be down to a dozen employees. It could be up to hundreds or thousands of employees, but typical client is about 50 to 100 employees. Typical time to close, although you could push this down to as quickly as 2 months if we're all on the same page and we're working very quickly and closely together. It can take longer than this as well if it's preferred, but typical client takes about 6 months to close, working at a very measured pace, not working too hurriedly. So why would you want to do an EOT as a business owner? I'll repeat again that I think it's best to think of EOTs as a private, flexible, low cost, easy to understand, and I'll add sustainable alternative to the ESOP. So most business owners, especially my clients, I find in my experience as a company advisor, really value privacy. A lot of my clients, they've been operating their business for a couple decades. The only person that really has full access to company financials are them and their CPA. That's it. If you're interested in employee ownership, and I have to say, I'm a big fan of the ESOP. So this is not a kind of, in fact, I always say I wrote a 300+ page PhD dissertation saying how great ESOPs are. So I think the ESOP is a fantastic tool. Okay. I'm a big advocate of the ESOP. But that being said, if you're planning on selling to employee ownership, if you do that to an ESOP, you have to know that ESOPs are kind of quasi-public transactions where you're involving a lot of different service providers, investment bankers, lawyers, trustee, multiple valuation firms, multiple lawyers, multiple law firms, and you can easily wind up on calls with 35 people, all picking through your company's financial records. That's just not comfortable for a lot of business owners. And with an EOT, you can just hire me, and I can get you there from A to Z. I'm the only firm that you need to work with. I'm the only firm that you need to hire to sell to an EOT. That's one advantage. They're flexible. With an ESOP, you have a sort of clear menu of options, and you have to pick from those options. And if you deviate too much from those options, you might lose the qualified tax status of the ESOP. With an EOT, and you'll hear this a bit with Bill as well, you can really choose what you want to do. I mean, I will give you, what kind of international ethical standards. If you want to call it employee ownership, I'll provide you with the information so that you don't stray from the kind of very broadly defined international ethical standards for employee ownership. But once we get past those very broad standards, you can really do what you want in terms of structuring the employee ownership trust. And actually, if you're somebody who is interested in environmental goals or other social goals or community goals, you can factor that into the trust, and you can include those goals in the trust. So if you're going to call it employee ownership, you'd have that as the highest goal of the trust, but you can also have these alternative goals layered in. You can't do that with the ESOP. You can combine an employee ownership trust with a family trust, right? So that's the kind of thing you can't really do, at least inside of the ESOP. Okay. Low cost. Just suffice it to say that the EOTs cost a fraction of what an ESOP costs to implement and to maintain over time. ESOPs have very high installation costs, and the annual year after year cost of keeping the ESOP is also very high. Whereas with an EOT, the year after year maintenance cost can be nothing, if depending on how you structure it. I think also I always like the phrase, keep it simple, student. All of the things being equal, I think it's better to do, generally speaking, better to take the simple course, and the EOTs much easier to understand for you as the selling owner. You don't need to do a year crash course in ESOPs. It can be much quicker than that. Likewise for your employees, for the employee owners, it's much easier to understand. And every ESOP practitioner worth their salt will be upright, will be forthright and honest about the fact that explaining what ESOPs are to your team is a very challenging process, and ultimately, can take years to really help your team understand what an ESOP is. I've heard it said, I think this makes perfect sense, that it's really not until the first generation of employees retires and gets paid out of the ESOP that the team really feels like it's real, right? It's also, EOTs finally are more sustainable than the ESOP. An ESOP can always get bought out by a third party if there's a sufficiently high offer. With an EOT, you can customize when, how, under what terms you would want to allow for the company to be sold out from under employee ownership. And if you're somebody who'd prefer to preserve the company and the legacy of the company under employee ownership for the long haul, you can also program that into the design of your employee ownership trust. So with all of those advantages, let me also say that in the current environment, as in right now, I think it's even better to do an EOT. For one thing, if you're savvy to the specific tax benefit that's granted to sellers to an ESOP when you're using a C corporation structure, it's known as the 1042 rollover. It allows you to defer payment of capital gains tax. Fewer sellers to an ESOP are even using that strategy. And so absent the use of that 1042 tax deferral strategy for the seller, this is a longer discussion, glad to have with you on a one-on-one basis, but it's really not clear what the big picture, what the financial advantage to the seller of doing an ESOP would be vis-a-vis the EOT. Another factor in the current environment is that investment bankers and private equity firms have really gotten laser focused on the opportunities in the lower middle market right now in a way that they've never been before. And so all of my clients say to me, and these are, again, $10 to $20 million firms. These are firms that a decade or two ago would not have been on the radar of investment bankers and private equity. They are now getting calls every day, once a week, with an offer to buy. And if you're somebody that wants to preserve employee ownership of the firm, then right now, if you sell to an ESOP, it's very likely that the company is going to continue to get offers, and they might even just a few years after the sale to an ESOP, not guaranteed to happen, but might have an offer that's too good to refuse, and where the ERISA trustee, the ESOP trustee, feels compelled to sell out, even against perhaps the employee's wishes. Unfortunately, there's also an increased level of ESOP litigation right now. That's not a great thing to have to deal with, and I think there's substantially less litigation risk in EOT. And because of the increased litigation risk, there are also even higher costs today than in previous years in establishing an ESOP. And again, that's a factor that I think would encourage choosing an EOT. So with that said, we're going to now go to our case study with Bill Foster. So let me just stop the share here. Okay. Of BioWorks. Okay, so Bill, welcome, and thank you so much for agreeing to do this webinar for the New Jersey, New York Center for Employee Ownership.
Absolutely, Chris. Happy to.
Oh, so glad. And, Bill and I worked together about a year or two ago to help structure his EOT. And so just to first get a sense of, what you guys do, I thought we might begin at the beginning and find out a little bit about how you got into the specialty agriculture industry.
Sure, happy to. I'll try to make the story short. The company was started in 1993 based on some technology that came from Cornell University, research station in Geneva. If you want to end a cocktail conversation, you tell them about what you actually do. So we grow mold. So the professor at Cornell found some plants that were living under certain conditions and isolated this fungus, and we can actually start to we can grow the fungus commercially. It's regulated by the Environmental Protection Agency, so we our products are EPA registered. So the company was started in '93. I joined the company in 1998, so I try to be really clear that I'm not a founder of the company. Not that that matters, but I don't want to give credit where credit isn't due. And then we were growing slowly. A lot of companies in that same space were starting that were trying to provide alternatives to chemical pesticides used in agriculture. A lot of private equity money went in. BioWorks was one of those. As my story goes, luckily I wasn't very good at raising money, or we wouldn't have been able to buy the company, which I'll talk about. But there's this whole idea of instead of using chemical insecticides or pesticides to control insects or diseases, you can actually do it biologically using organisms that Mother Nature produces for us, but being fairly observant about when they work and when they don't work. And so there's this whole industry called the biological products industry that was formed again in the 80s and has been growing significantly ever since. And we're part of that industry. So yeah, it's been a blast. I love it.
That's fantastic. And what got you to the point in terms of your tenure at the company that facilitated the transition so that you actually became the owner? That's kind of,
Sure.
That's not my typical client, by the way, where they don't, typically my clients are the company founders.
Yeah. We were growing, 10-ish% a year, but we had 220 shareholders at one point in time. And we never felt that we would become the investor's dream. Even today, compared to what the original expectations were, we're not the investor's dream. And so in 2007, there were 5 of us back then, we approached the board of directors at BioWorks and said, hey, we're interested in buying the company, a management buyout. Mm-hmm. As I recognized later on, a highly leveraged management buyout. But we approached the board. We negotiated with the board for an excruciating 28 months. As I joke with someone, at some point in time, I'll write the book on it. Although I don't know if I want to relive the whole scenario again. But the outcome was fantastic. We ended up in 2010 buying the company, 5 of us. And then over the next about 5 years, we slowly paid off the debt that we incurred from the original management buyout.
And are those, I can't recall, have you since then bought out some of those other partners, right?
Right. Yep. So there's now just 2 owners of BioWorks, right. Myself and another gentleman, and we bought out the previous 3.
Okay, so that's fantastic. So you finally own the company, and now you're going to give it all away.
Right, exactly. Yeah. If you talk to some business owners, traditional business owners, they look at me and say, "What is wrong with you?" Because one of the slides you put in there is so true. I still get calls, if not every week, probably every other week, of some private equity company, someone interested in looking at buying the company. And it is just so, I remember the day the management buyout closed, I slept, I think, the best I've ever slept, because every time the phone rang up to that point in time, I figured, hey, it's my fiduciary responsibility to talk to them. And I just kept on envisioning the employees. I think back then we probably had maybe 30 or so. What am I going to tell them? They have committed their career to BioWorks, and I have to go tell them and say, oh, by the way, I know you've been working with us for 10 years, but it really doesn't matter anymore because the owners wanted, and I'm not going to fault the shareholders at all, but that's just not part of my DNA. I just didn't want to do that. So when we bought the company, it was just a nice, relaxing moment for me. So I no longer had Pavlov dog's response and cringed every time the phone would ring or something like that.
And of course, the Rochester region has its own sort of saga with firms closing, et cetera. I mean, what would happen if a company, if you had sold, instead of working with me, if you had sold to a third party, what would what would be the most likely scenario? I mean,
it's tough for me to say sometimes. I've talked to the companies that had expressed interest in acquiring us and still do. And it's wonderful to tell them to say, we use the term perpetual purpose trust.
Yeah.
Because when I say EOT, most everyone hears ESOP. And
yeah.
so I sort of say it's okay, no, it's different. And I go into explaining why a little bit. But we still get companies interested in buying us. And again, it's just wonderful to be able to say, I could say no starting in 2010 is now more fun to say no and tell the story behind it and why. But typically what they'll tell you is, okay, for the first 5 years, we're going to treat you as a standalone. And then after 5 years, you're coming under, our company, the mothership.
Yeah.
And for us, you talked about legacy. The culture at BioWorks is the most important thing to me, retaining that culture. We have a fairly unique culture, and we attract high quality team members because of our culture. And the last thing I wanted to do was destroy that culture. And the potential buyers would say, don't worry about it. We're going to leave you alone and everything else. It's like, I'm sorry. I just don't believe that.
That was going to be my next question.
Yeah.
Would they really leave you alone for 5 years?
Exactly. Yeah. They'd leave you alone for 5 years because that's what the earnout probably would be over a 5-year period.
Right.
And then after you're gone, thank you very much. And they take the technology and some good people and what they perceived as good people. Yeah. And then everyone else would be out looking for another job. And that's, again, that part of why we are where we are with BioWorks. That wasn't the intent originally. The intent was, I was just joking the other day with someone, why did they bring you in as CEO, Bill? I started with the company in 1998. And my job was to do deals and sell the company. My job was, figure out how I can increase the value of the company and give a profit to the shareholders, not the stakeholders, the shareholders. Right. And I was okay with that until, my story goes, I fell in love with the company and the people and said, there's got to be a better way. There's just got to be a better way to run a company.
Right. Well, that speaks then to what was it that had you kind of gravitate from that, role as CEO and shareholder, value maximizer? What specifically made you think about employee ownership? Or is it more, and this is again absolutely fine, is it more the kind of the perpetual purpose aspect of things and the business legacy aspect of things, or is it the employee ownership side of things or is it some combination of those?
It really goes back to the purpose, why we exist. And we share this readily. It's 3 parts: grow our team, serve others, and save our earth. And I won't spend a whole lot of time going into that. It's funny. I looked at an ESOP. I went to an ESOP conference in Arizona probably 7 or 8 years ago, thinking ESOP. And then I remember I read a press release about New Belgium Brewing Company and, being acquired. It's like, naively, I kept on thinking, well, that doesn't seem possible. And luckily in Rochester, and we had connected with Rob Brown, who's an ESOP expert. And I said, Rob, is it possible that an ESOP company can be acquired? He was probably rolling his eyes at me at that point. I said, where have you been? And he said, yeah, it's if the valuation is significantly higher then it's the fiduciary responsibility to recommend to the shareholders to sell. And I remember that just created a pit in my stomach, thinking, well, I can't go down that way. To me, it's the people that helped build the company that should be rewarded with ownership, not necessarily maybe stock ownership, but owning where the company is going to go. And funny enough, our corporate attorney, I called our corporate attorney, and he was working with a client of yours who I know fairly well. And he said, Bill, he said that your timing is perfect. You know, I'm working with this other company about an employee ownership trust. Here's what it is. It's like, that's it. That's exactly what we want to do. And so learn more about it. And, you know, it's been a great story,
I understand that you have made some changes there. So maybe you could speak to some of the changes that you've already introduced at the company.
And so we created the trust. We had 2 board members. We've actually added a 3rd board member. He's elected by the employees. And this year, actually, we're just starting this quarterly rhythm of board meetings, reviewing how the company's doing. We had always actually, when I prior to the management buyout, I was reporting to a board of directors, and every quarter I would give them a board update. Well, I liked that process of communication and sharing, so we continued that even when even after the management buyout, and we're going to continue that going forward. So I envision myself at some point in time stepping away, being a trustee, but stepping away, saying, okay, I want to know what's going on with the company. We're going to have these regularly scheduled board meetings that overlap with company-wide updates. They last about an hour and a half. And we talk about the status of the company. We'll add some other things, you know, about how we're doing regarding our core purpose, how we're doing with our core values, employee satisfaction. We'll be adding some things to that. But there'll be quarterly board meetings where we talk about that, and that's a way to share information, not only with the trustees, but also with everyone in the company. So probably the 2 biggest things is we added an employee to the board. And the second part is we'd always had this variable compensation plan bonus that we modified, not so much because of the perpetual purpose trust, but again, because we thought it was the right thing to do. And that is, we have a profit sharing plan, and we used to share it based on your compensation. So if there were, you know, 10 people in the company and the highest person, you know, made 5 times as much as the other person, that person would get 5 times as much in their bonus, their variable compensation plan. And we said, well, you know, that's interesting. We did that for a few years. We said, but, you know, from a fairness standpoint, what if we shared the profits equally? So if we made, you know, at the end of the year, we made $100 and there are 10 people in the company, now everyone gets $10. And so regardless of your position in the company, there is a component of tenure as far as when you started in that year. Excuse me. But once you've been with the company for a year, you're participating and getting a bonus at the same level that everyone else is. So that's sort of a second thing, but it's just consistent with this idea of people, the purpose of the company. Going back, it's the team that's creating the value of the company. Value that will not be recognized, which is perfectly fine, except in stock appreciation rights. So that's the third part we're doing is we're modifying and enhancing our stock appreciation rights plan so that the opportunity for wealth is created by everyone on a regular and ongoing basis.
So that's a really interesting point. There's a lot of interesting stuff there. I mean, one is, you know, of course, you don't need to have any kind of employee voting rights at the company within EOT, but you guys chose to have an employee elected board member. You know, also, although it's much more common to use a compensation basis for profit sharing, it's certainly a more egalitarian approach to use equal profit sharing. I mean, everybody's working full time, and you know the modest differential between compensation levels might, at the end of the day, might be simpler and easier and a better feeling in a way to just make it equal for the profit share. Again, that's going to be structured differently at different companies. And then the last point I think is fantastic because there are some folks, particularly in the ESOP community, who just to them employee ownership means capital gains.
Mhm.
And it's been almost this is the way that they've been doing it in the UK for decades, but it's almost as if it's been difficult for people, some practitioners, to accept the notion that you can actually combine EOT ownership and equity ownership and capital gains. And so, here, and of course, we have examples of this in the US already, but here's another example where you're layering on SARs or expanding an existing SARs program.
Yep.
In conjunction with the EOT, and they can work perfectly well together. And
Yep.
you said you said earlier you expanded the grant.
Yes. We when someone joins BioWorks, we give them 25 SAR units right up front, vested over 5 years, and then every year we give everyone the opportunity to buy up to an additional 100 SAR units. We do go through a formal third-party valuation process. The banks like it, we like it, just because it gives us a sort of an outsider's perspective of how things are going. And what we recognized, though, was, what I liked about an ESOP was this idea of you could create, I'll say, significant employee wealth at that point in time. And 25 SAR units are nice, but we're not going to create significant employee wealth. So we want to figure, and we're still in the process of working it out, but we want to figure out a way in how we can give like regular tranches of grants. Don't know what that number is. There might be some ownership, not ownership, but responsibility component to how many SAR unit grants we'll give you. And we're still working through those details, but we want to be able to create this opportunity that when someone leaves BioWorks after working here for, 15, 20 years, they're looking at anywhere between $150 to $250,000 of appreciation in value, so that it just allows them to live a lifestyle that they want to live. So that's what we're targeting right now.
That's fantastic, and that's actually right on par with the kinds of account values that you see typically on average with ESOP. So this has been such a fantastic conversation, Bill.
Fantastic.
Chris, this is great. It's always and Bill, thank you so much. It's just listening to your story helps educate me, as I learn even more about the ESOP and employee ownership process and EOTs. So thank you everybody for being here. If you would like to know more about what we're doing and view past webinars, go to ownership.rutgers.edu. Chris, can you throw up that slide? If you can. If you can. If not, I'll just say it slower. There we go. Perfect. So it's ownership.rutgers.edu. You can, there's contact information for our executive director, Bill Castellano, and Jim Therese, who's here with us today, and myself. If there's a topic that you would like us to do a webinar on, or you want to know more about, you can contact us for that. I will reiterate that we are going to be announcing, doing a marketing blast and announcing our new employee ownership online program, which is going to be focusing on minority business owners, minority and female business owners, but it's open to anybody. So, and it's free. It's going to be really exciting. So you'll hear more about that from us very soon. And also, we're going to be this was a recording, so we're going to be sending out the recording to everybody who was here and who wasn't able to make it today. So look for that in the next day or two. And Jim, you have any final words for us?
Thanks, Bethany. I just wanted to thank you, Bill and Chris, for joining us today. That was really great. Really appreciate it. And thank you to all our participants. We really appreciate you joining us. I hope everyone has a good day.